When creating your financial projections, we're going to talk about different things that you have to think about. We're going to talk about the terms and what to include in your financial sheets to make sure that you're covered on all these different levels. First thing is the startup cost. When you start a company, before you even get to an operation standpoint, you need to spend some money. That could be in terms of a logo, in terms of graphic design, in terms of software developers. Maybe you're not a programmer and you're hiring third-party developers in order to design it. So what are all these expenses that are associated with starting up your company? Remember, we're not getting to the point of day-to-day operations. This is all upfront funding that you might need. Some companies might need very low startup cost. And that's really why you see a big boom in tech companies, because the startup cost is very low. You can set up a server. If you're a developer, you can set it up on your own. And there you go. You have an app or a website that's ready to go. If you're a product, it's slightly more difficult, because if you have a product, then you need to maybe a mold, you need prototyping, you need some machinery. All these different things are part of the startup cost. So we need that money up front, maybe 100, maybe 200K. We need that money up front before we even begin to operate our business. The second thing that we think about is, okay, well, the company is started. We were able to get $200,000 in order to start this company, but now we need to think about our operating costs. So those are day-to-day expenses that are incurred by your business. So that could be payroll, that could be utilities, that could be insurance, marketing, servers, office supplies, travel, rent. All these different things come into your operating cost. Now, every business is different. If you're a product, some of your operating costs might be your COGS, which are costs of goods sold. That is, if you sell a product for $20, that's not $20 of pure profit. That is $20 of revenue, but you also have a piece of that $20 just for pure materials that you need. So you need to include that also in your expenses. So every business is different, and depending on what you're trying to operate, whether you're a service, a product, a tech company, you might have different operating expenses. So I encourage you to go ahead and outline those, because we're going to include them in our financial projections and the demo that we're going to do in another video. Now, your cash inflows. Where's money coming from? This is really the hardest thing to do for a startup, because when you start a company, you might think about one way to generate money. But I encourage you to think about multiple ways that your business model could be expanded. Is the money coming in only from investors? Maybe it's sales of goods. Maybe it's subscription service. Maybe it's a delivery fee. Maybe it's a licensing fee. All these different things I want you to think about as different ways that you can make money. Take a step back, think about your product or service. How can you generate one additional dollar from the existing infrastructure that you have without adding additional expenses? It could be difficult, and it is difficult, but it's your job to figure that out. But if you make more revenue, your operations and your growth is going to be a lot better. Now, we talked about break-even analysis in another video. It's basically the point where your revenue at a bare minimum meets your expenses. So you're not losing money on a month-by-month basis. And do not feel ashamed if your company does not reach break-even point till the second year. There are still companies till this day who have not reached break-even points, and they have millions and millions of users. But because of the engagement of those users, they're able to go to investors and raise more money. So I want you to be very conservative in your projections. And when you do those numbers, don't just say, hey, we're going to break even point the third month, right? We're going to have break even third month. We're done. Where profitability is just going to go skyrocket from there. It doesn't really happen that way. So keep those in mind when you do the analysis. So in terms of a general capital cycle, you have cash, you can do some purchases, you have some materials if you're a product businesses, you have some accounts payables that you have to pay, then you do some production fees, then you have some finished inventory, then you have some sales on account receivable and collection. So you can see all these different things are going to come together, and that's how the cash is going to flow in your business. Some of it's going to go out, some of it's going to come in, but understanding those principles allow you to operate your business in a better way. So go ahead and work with your team on that. Negotiate, talk about it, try to dig deeper and look at competitors in this field and what their financial projections might look like. Some of them might be public. You might be lucky and find maybe an older company who has shut down, have done a presentation somewhere, and they talked about this kind of stuff. So look at different businesses, at least in the same discipline, and see what kind of expenses and revenue models are they using. So the three main statements that we're going to focus on are the balance sheets, the profit and loss statement, and the cash flow statement. Let's start with the cash flow statement. because it seems the most obvious one, right? Cash flow is cash in and cash out. Where's money coming in? Where's money going out? Understanding that cash is king and how much money that you have in your business actually dictates what you can do is a pretty big thing. How many of you have seen a Shark Tank episode where it says, oh my God, we have this big purchase order, PO, right? And but we can't satisfy it because we don't have any money. That's what we're here for. We're here to raise money in order to satisfy a sale. Cash is king. Knowing how much cash you have in the business will allow you to know how long you're going to operate. So as a general perception, here's basically a general diagram that explains to you where cash could be coming in and where it could be going out. So this is just, again, 10,000 feet in the air, but it's up to you to break this down even more and to outline this in your financial projections that we're going to talk about in a second video. The second statement is a profit and loss statement. So sometimes you might hear it's a P&L statement. That's really what it means. It's a profit and loss statement. It shows your profit. It shows your basically revenues and expenses. And by the end of it, it shows any losses or profits that you might have. So a profit and loss statement is a really important document. A lot of investors ask for it. It should be a really vital document for you in terms of operations on your team because it allows you to see where the profitability is coming in, how different decisions will affect your company. So when we get to the point of doing the financial projections on the Excel sheet, you're going to see that we're going to try to link a lot of the cells together. The reason for that is we want to basically make decisions that are based on those projections. So what happens if we hire another developer? What happens if we don't hire this marketer for another 3 months? So you can make those decisions, and you can see by changing the cell value from 0 to 5,000 or whatever it is, or by changing your growth rate, you can see how your general 3-year projection is going to change without actually going to that scenario. So hopefully, your Excel sheets are guided enough and they're linked enough and they're based on true facts that you can see before you even make that decision what's going to happen for the company financially. For the profit and loss details, we're going to outline the sales. We subtract the cost of goods sold, and that basically creates your gross profit. Then we're going to subtract the operating expenses, and that basically creates operating profits or earning before interest and tax. Then we basically subtract any interest that we have to pay, and then we basically get to an EBT, which is earning before tax. Then everyone has to pay taxes, so we have to subtract the tax on a company level, and that leads to your net profit. So you can see that you have a lot of subtractions from the time that you generate your revenue to the time that you get to your profits. So think about those, again, when you create your financial projections. Now, finally, it's your balance sheet. The balance sheet basically gives like a general overview of what your company is doing. It gives an overview of your current assets. That could be cash, could be real estate, could be any loans that you issued, could be stocks. It also gives overview of fixed assets. That could be furniture, equipment, computers, servers, anything like that. On the other hand, it also gives an overview of all the liabilities that you have. So that could be credit, that could be debt, any long-term loans they maybe have from investors or from the bank, and all these different things. So it gives a general overview of the state of your company in terms of assets, liabilities, and equity. Now, go ahead and watch that additional video that will give you an overview of how to create financial projections in Excel. It will be a screen share for you, and it will be a guided tutorial. Your company might be different than that tutorial, but again, it's based on different operation, whether you're a product, service, or a tech company. Now, why do we do all these different things? We do this in order to allow us to understand the operations of our own company, allow us to understand how different decisions will affect our company, and finally, in order to create an overview for investors on how our company is operating. An investor is always going to ask for a 3-year to 5-year financial projection document. They know there are projections, they know there are assumptions made, but it allows them to feel confident that you as an entrepreneur have thought about everything that's required in order to operate and expense in your business, and it allows them to feel confident that you thought about the projections in terms of growth and where do you see this company in 3 years. It also allows you to understand, is your company really going to be profitable? Maybe that business model of you need to download an app for 99 cents is actually not that profitable after all. You need to think about other revenue models. So you think about all these different things. So it's really a self-guided exercise for self-reflection, and it's also a good document to have for external investors. What we expect is usually 3 years in financial projections, break-even analysis, as we said, and the estimation of cost, which is basically how much money would you ask for the investors. Take into account that if you think you need $1 million, add a safety factor in there, multiplier. If you need $1 million over the next 12 months, there are going to be other expenses that pop up. Your product's not going to hit the goals that you thought they were, going to hit in terms of sales. So always be safe in terms of those projections. And it's always better to raise more money than less money, because if you run out of money, then you go back and you're like, hey, remember me? I actually did not hit the goals that I told you I was going to hit. Can you please give me more money? It's not going to work that way. So it's better to raise more money, hit those goals, than to actually be less on the money that you've raised. So, toward the end of this video, I want to highlight the top 10 things that you as an entrepreneur and as investors look for in terms of a startup financial. And it's kind of a summary of everything that we talked about. The first thing is revenue growth. How do you see the revenue growing in the company over the next year and then 3 years from now? So, and how is that growth as a result of operations? What are you doing differently that's going to lead that growth rate to basically increase and to have that nice hockey stick increase in operations? The second thing is the net income. So the net income is basically the revenue minus all the costs incurred. So it's basically your net. So how is that net going to change? As your revenue increases, are your expenses also increasing at the same rate that your net income is not increasing, and maybe you're still generating some losses? So those are some things that a net income statement will allow us to get. Then we talk about a gross margin, which measures how expensive it is to make a product. So if you're in a product level or even a service or an app, how much does it cost you to make that product compared to how much you're selling it? So we see on Shark Tank, we say, oh, we have a profit margin of 20% or 5%, and you kind of see different frowns from different investors depending on the industry that you're in, because different industries have an expected profit margin to be in. A contribution margin is basically measures the profit per unit without considering the fixed costs. So the fixed costs are not considered when you're trying to calculate your contribution margin. Now, the contribution margin also ranges from 5 to 25% depending on the sector that you're in, and you can use a lot of resources like Crunchbase or a lot of financial websites in order to figure out what sector your business falls in and what is usually the range of your contribution margin. Now, customer acquisition is a pretty big thing because, again, we're projecting an increase in the revenue. So how are we acquiring customers? What is the cost to acquire a new customer? How long is that customer with us? That's when we get into basically churn, or how fast are we able to retain customers, or how fast customers are leaving us. So that really becomes a big thing in terms of maybe if you have a subscription app, if someone subscribes for your service, how long are they staying as a member? If you're a member of Netflix, can you guys remember how long you've been paying for Netflix? Those are different things that you have to take into account when it comes to churn. So how fast are we getting new customers in, and how long are they staying with us in terms of repeat orders? The biggest thing as a startup is salaries. Well, you need to think about your salaries, whether you're paying them really low income or you're paying them high tier. If you're looking to raise funding, you need to basically get top talent. None of your products or services are going to be able to get built unless you have an awesome team. And guess what? That awesome team has expenses of their own to live. So you have to pay them in order for them to work, in order for you to reach an awesome product. Now, your sales quota are how easily is the product sold? So are you able to reach those quotas? Are you able to penetrate the market? And again, that sales quota is relatively dependent on your growth rate. Then you get to the next stage, which is marketing. Usually marketing is about 30% of your expenses. So in non-personnel marketing is basically everything that you have to spend that's not dependent on marketing people on your team. So that could basically mean Facebook ads, different print ads, flyers, anything that you do in order to market your product or service that's going to cost you some additional expenses. So you want to think about non-personnel marketing. And then the general theme is if your team has 5 people, what is the revenue per employee? So is the team able to generate enough revenue to satisfy a big team? And one of the cool things that you can think about is the difference between a physical product like a retail store like Walmart compared to a tech company like Google. The revenue per employee for Google is a lot higher. Google has less employees than Walmart, but Walmart has a lot of those operations. So you have to think about those different things in terms of revenue for employees. So that is it in terms of general understanding of the financial principles. The next video that we're going to talk about will include investor information about funding your startup, different ways to raise money, and how to basically take your company to the next level financially by getting external funding.